Hi there, welcome back. Let's demystify IRAs. Ooh, what an exciting subject. Well, it is if you're a tax planner or financial planner, or you are an IRA owner and you want to know how to deal with this stuff. So let's start with an IRA. An IRA is an individual retirement account. You create it either by putting money in, taking the tax deduction, and setting it up basically on your own. You can set it up with a brokerage account, a bank, insurance company. Those are usually the three places people establish an IRA. And you put money in each year. Or maybe only do it a couple of years. And maybe it depends on your income, how much income you have, and whether or not you'll get the deduction. Various reasons that you might choose to put money in or not. Now, the other way an IRA is created is when you have worked for a company and have established a qualified retirement plan account. You say, what in the world is that, David? Well, here, let me give you the more familiar terms: 401k, 403b, 457, lump sum pension plan payout, money purchase plan, profit sharing plan. I can go on and on. Well, I think that's it. But anyway, there are a lot of different types. So what happens is when you terminate employment, you can roll those funds from those employer-based plans into an IRA, and it's called, real clever here, ready? An IRA rollover, or 401k rollover into an IRA. When you're transferring money from one already established IRA to another, here again, clever terminology, it's called a transfer or an IRA transfer. So there are a lot of different ways to get an IRA. Now, when you have retired, you start drawing on your IRA or not. You may not need to, but if you haven't, you have to start at 70 and a half. You start drawing money out, the IRS gives you a specific formula that you have to use. It basically amounts to about 3.5% the first year, at the year you turn 70 and a half, and then every year thereafter, the percentage you are required to take out goes up. Now, the dollar amount you're required to take out will depend on how much money is in your account and whether or not it's growing or not. So if you just have your money sitting in cash, and it's not growing, and you have to take out an ever-increasing larger percentage, then you can see how your account, of course, will be decline and be drawn down. But if you have good growth, or at least hold on to what you're having to take out, make at least that much, then there's a real good chance, again, if you don't need the income otherwise, and a lot of people do, but if you don't need the income, then your IRA is going to accumulate, or at least there'll be something left over when you're finished with it, meaning when you die. Now, there's three different places that your IRA can go when you pass. One, for married couples, you can leave that money to your spouse, and they can do what's called a spousal rollover. You pass, they can take that IRA and make it their own, basically. If they already have an existing IRA, they can transfer your IRA into theirs. Now, there are some very specific rules about how quickly they have to draw money, depending on whether you've started taking your required distributions or not. But to put it simply, they can transfer it over into their own name, and then they can draw out based on required minimum distributions. Now, the second place your money can go is to other people besides your spouse. So brother, sister, mom, dad, children, nieces, nephews, stranger, whomever you decide to leave that money to, that's called a non-spousal rollover. Clever terminology, right? So non-spousal rollover means that it's not going to get this special treatment I just referred to with spouses, meaning that when the money is transferred, if they just take it all out or attempt to roll it into their own IRA, that would be a tax catastrophe, because all of the money in the IRA will be forced to be taxed at that point. So what else can you do? Well, the person who's receiving the IRA can bring that over and treat it as what's called an inherited IRA. And that's really the heart of what I want to talk about. The inherited IRA, it rolls over. There's no taxation at the time of the transfer if you do it correctly. And the IRA still is designated in the name of the person who passed. So it's not really treated as your own IRA, but you are technically the owner, and you are then required to start drawing money out regardless of your age. You could be 30 years old, and you've got to start taking out required minimum distributions. those tax tables that say how much you're required to take out that usually people are familiar with that start at age 70 and a half, well, that chart, there's a lot of other numbers on it that go up to much younger ages. So if you're 30 and you have somebody dies and leaves their IRA to you, you have an inherited IRA and you have to start taking money out of it each year. Now, the cool thing or advantage thing about that is that you're not having to pay tax all at once, and it's a very small percentage, especially at younger ages. If you are very young, it might only be 1 or 2% you're required to take out. So the tax consequence is very insignificant. Now, the other place you can leave or gift your money to with your IRA, instead of a spouse, instead of a regular person, is you can also leave it to a charity. If you leave, you say you've taken care of family, you want to leave some money to a charity, you have an IRA, then if you're thinking about a specific dollar amount, if you've got $1 million, for example, and you want to leave $100,000 to charities and the other $900 to your family, well, from a tax planning standpoint, it actually might make a lot of sense to leave the IRA to the charity and other monies, maybe monies you've already paid tax on, to your family. So that $100,000 IRA, what you do is you designate the charity as the beneficiary, you pass, they receive the money, but because they are a charity, not-for-profits don't have to pay tax on that IRA that they are receiving from you, in effect. So it's a nice way to, number one, benefit a charity first and foremost, but number two, escape the taxation. And it makes sense from an overall, how our society works, how our tax system works. If you think about it, you're not really cheating the government. There's nothing wrong with this. And if you think about it, the fact that you are giving that money directly to the charity lightens the load maybe of government or taxpayer-supported contributions to charities and charities like that one. So those are the different primary ways. Now there's one more way that's a little bit more involved and a little more complicated, but it is an option, is you can have your IRA money go to a trust. You have to be careful with a trust because the advantage is that the IRA can be, the trust can be named as a beneficiary, the money can go to the trust, and then the trust can determine how monies go and how quickly they go to beneficiaries. The careful part I'm talking about is that if you don't do it correctly, and this is where it's well worth working with an attorney to have them set this up correctly, because if you don't do it correctly, then it's very possible that the trust could end up paying a ridiculous amount of tax on very little money. The numbers which I've got, this is really remarkable. If you left the money to the trust instead of doing it correctly, then you might end up having all of that money be taxed as high as 40% tax bracket. The 39.6, if you don't set up the document correctly, don't have the IRA money going into the trust correctly, there could be as much as 40% taken right off the top and that money go to the government. Instead, if you do it correctly, very little tax can be paid. Then the people, as they receive the money, can pay tax on it as they go along. So when you get into some of these different options, you want to be careful. The bottom line is that an inherited IRA set up correctly can be fantastic, not only for getting your money where you want it to go, but also keeping the overall tax burden lower. And if you keep your tax burdens lower, you know what I'm going to say, you can plan stronger.